Okay, so real talk. Remember when the Iran conflict was everywhere? Every news channel, every podcast, every group chat. And then suddenly, it just kind of disappeared from the conversation. Ceasefire happened, people moved on, and now everyone's talking about something else entirely. But here's what's been bugging me lately. Just because the news stopped covering it doesn't mean the damage stopped. Because I've been looking at the numbers, and honestly, the financial fallout from this thing is still very much happening. Like right now. As you're watching this. And I know that sounds kind of dramatic, but stick with me for a few minutes because this actually affects your everyday life more than you might realize. Let's start with something super simple. When's the last time you filled up your car and didn't cringe a little? Gas prices crossed $4 a gallon earlier this year. That's the first time that's happened in over 3 years. And if you've noticed your grocery bill creeping up, your utility costs feeling a little heavier, that's connected to the same thing. It all traces back to what happened with oil when the conflict escalated. See, when there's instability in that region, oil shipments get complicated real fast. Exports get restricted, shipping routes get risky, and the market just panics. Even after the ceasefire, energy prices are still sitting about 30 to 40% higher than they were before any of this started. That's not a small bump. That's a significant shift. And here's the thing most people don't think about. Energy isn't just gas for your car. Energy is basically the cost underneath everything. When it goes up, transportation costs go up. Manufacturing costs go up. Getting food from the farm to the store costs more. So that price increase doesn't stay at the pump. It spreads into literally everything you buy. That's just how it works. So U.S. inflation hit 3.3% in March 2026. And I know that number sounds boring, but let me put it in context. Just 1 month earlier it was 2.4%. That's a pretty big jump in a very short amount of time. Gas alone jumped almost 19%. Fuel oil went up over 44%. And the frustrating thing about inflation is that it doesn't feel like one big hit. It's more like, you know when you have a slow leak in your tire? You don't really notice it at first. But then one day you go out to your car and you're like, oh, that's definitely flat. That's inflation. It's gradual, it's quiet, and by the time most people really feel it, it's already been going on for a while. Your salary probably didn't go up 19%. Your rent didn't suddenly get 44% cheaper. So that gap between what things cost and what you're actually bringing home, that gap is getting wider. And that's a real problem for real people. Okay, so here's where it gets a little interesting from an economic standpoint. Normally when inflation spikes, the Federal Reserve raises interest rates. That's their go-to move. Make borrowing more expensive, slow things down a bit, bring prices back under control. But the Fed is in kind of an awkward spot right now. They actually cut rates 3 times in late 2025 because the economy was slowing down and needed some breathing room. Now inflation is jumping back up because of the energy shock. So what do? If they raise rates, they risk hurting an economy that's already under pressure. If they leave rates alone, inflation keeps chipping away at everyone's purchasing power. From what analysts are saying, they're probably just going to hold steady and wait it out. Which honestly, I get it. But it also means if you're carrying a mortgage or a car loan or any kind of debt with a variable rate, you probably shouldn't hold your breath waiting for things to get cheaper anytime soon. Here's something that I think gets completely overlooked in these conversations. Wars are expensive. Like, absurdly expensive. And that money has to come from somewhere. The U.S. federal deficit is already projected to stay above 6% of GDP through 2030. That's a big number. And what happens when governments carry that kind of debt is that it starts crowding out private investment. Businesses can't borrow as easily. They expand more carefully. They hire more cautiously. And that slow drag on growth doesn't show up in a dramatic headline. It just quietly makes the economy a little less dynamic over time. The weird thing is most people never connect their current financial reality to decisions that were made 5 or 10 years ago during some conflict they barely remember. But those costs linger. That's just the reality of how this stuff works. Now here's something I actually find kind of fascinating. When the conflict escalated earlier this year, not everybody panicked. Some investors actually saw it coming, not the specific event, but the pattern. Because this pattern isn't new. War breaks out, Energy prices spike, inflation follows, the Fed gets squeezed, markets get volatile. That sequence has played out before. And people who recognized it early moved into energy stocks, gold, defensive assets, before the mainstream headlines caught up. And they did pretty well. I'm not saying you need to become a day trader, but I do think there's real value in just understanding how these things connect. Because when you see what's driving prices up, you can make smarter calls about your own money. Where you keep your savings, how you're invested, whether now is a good time to take on more debt. That kind of awareness actually matters. Look, I'm not here to stress you out. The world isn't ending. But I do think a lot of people are feeling the financial pressure right now without totally understanding where it's coming from. And that feels like a gap worth closing. Higher energy costs, sticky inflation, a Federal Reserve that doesn't have a lot of room to maneuver. This is the economic reality of 2026. And it's a direct consequence of what happened overseas, even if the news has already moved on. The more you understand about how this stuff works, the better positioned you are to handle it. That's genuinely why I make these videos. So if this was helpful, subscribe. I put out new content every week breaking down exactly what's going on in the economy in a way that actually makes sense. And drop a comment if there's something specific you want me to dig into. I really do read them and I take them seriously. Alright, I'll catch you in the next one.